Welcome back, guys, to another Zero DTE video, and today Ernie's going to be talking about futures insights, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
Two things that are very highly correlated are futures on bonds, right? Like the difference between the 5-year and the 10-year. If you were to watch them, they move up and down tick for tick almost exactly. Now, the magnitude of those moves tends to vary over time, and every once in a while they become divergent, and that's what actually creates the yield curve and how it will go up or down or bullish or bearish or whatever, because that divergence happens. But eventually it rights itself. Not always, and not on anybody's particular time frame.
Yeah. Back in 2008, I was playing correlation between the euro dollar and the dollar Swiss. I think that was the pair of currencies that if you pair them up, they went in exactly the opposite direction of each other. And there was a whole strategy. And anyway, that's what I was playing with currencies and lost a lot of money doing that. But anyway, that was fun.
Yeah. But see, even that only had about an 82%, 85% correlation factor.
Okay.
Which is relatively low when you're talking about pairs trading. The 5 and 10-year have about a 97% correlation factor.
Wow. Okay.
So it's a completely different animal. There are a lot of other different types of arbitrage that you can do with futures, particularly in the energy sector, like anything that is an oil derivative, crude oil derivative, because there are so many different products that come off of that, off of the same exact process. And so the correlation between those products are very tight, like the correlation between crude and home heating oil, which is called the crack spread. Because what happens is anybody that's from Texas probably knows about this from refineries, if they're around for refineries at all. But you distill oil through something called the cracking process, and that's why it's called the crack spread. And then it refines it down to different elements of different products from the original crude oil, home heating oil, gasoline, jet fuel, so on and so on. There's about 5 or 6 different natural gas, etc. And then you can trade the difference between the two, any one of these products. Wow. And there's a very high degree of correlation, just like there is in bonds, because they're almost the same thing and they have a high degree of correlation. There's also something called the crush spread, which is in agriculture dealing with grains. So the different products that come from cornmeal, corn oil, etc., and soybean, soy meal, soy oil, etc. So all of these things are standard things that most traders trade, but the traders themselves don't usually make money off of them. The reason why the spreads were originally there and the reason why the futures were originally there was to help normalize the cost of people who are actually in the industry, the actual underlying commodity industry, so that they could normalize their prices from the time that they start the process to the time they bring it to market. And then the spreads or the arbitrage was really a way to play the overall margin shifts in the market. Then, of course, the reason why there are speculators out there like us or other traders, they come in thinking that they can play the same thing, but purely from a speculation point of view, they have no interest in the actual underlying commodity. They were brought in mostly because they needed more volume in the market in order to make it a market. And so that's what speculators are for. They're there not to provide any value to the market, just to provide volume to the market, liquidity.
Almost like an insurance company. You want a whole lot of insurance. People pay for insurance in order to cover the cost of the potential that you might lose your crop that year.
Yeah, so that's what futures are. And you got to wonder then why there are so few restrictions on people that get futures accounts. Like there's no pattern day trader rule. And that's mostly because they want these noobs and idiots to get in there and trade them so that they can provide liquidity for the market for the people who are actually driving the economy with real businesses and dealing with the underlying commodity. That's a cynical way of viewing it, but it's probably the truth. When I attracted a lot of money, and I made a lot of money and I lost a lot of money, made a lot of money and lost a lot of money. And the people that got out on the highs, God love them. The people that got out on the lows, they hated me. So you go through these waves of hero to zero. And then later on into that, I started to attract other people and then mentors that started to really give me the lowdown on what actually worked over the long term. And that's how I started developing this strategy. It's an interesting thing, trading this way. What we're doing is, in fact, an extremely sophisticated strategy that if you had a very large fund, really the only way that we could trade this is with significant compute power and PhDs and that sort of thing. But we're taking a very different approach to that, where We're much more agile and able to trade at a much smaller price. And that's what gives us that agility. And you are able to extract a nice little profit from it. Once you start getting up into the 10, 50, $100 million category, trading this strategy becomes extremely difficult.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.